Tesla's revenue declined last year. Not slowed, declined. For a company still priced like the fastest growing name in the market, that's a structural contradiction that deserves more attention than it's getting. The margins are compressing. Price cuts are not moving volume the way they used to. In the United States, in Europe, and most critically in China, Tesla is surrendering market share. BYD has not just caught up, it has lapped Tesla in volume terms and is now expanding internationally. NIO, Li Auto, and Xpeng are occupying the mid to premium Chinese EV segment that Tesla once dominated almost by default. What's changed is the competitive floor. 3 years ago, buying a premium EV in China essentially meant buying a Tesla. That optionality no longer exists. Local brands have closed the quality gap and undercut the price point simultaneously. Tesla's response, further price reductions, is working against its own margin structure without recovering the volume. The analyst community is divided, but the direction of the argument has shifted. One prominent bear, who was a long-term Tesla bull through most of the EV build-out phase, has concluded that a great company and a great investment are not the same thing. At 200 times earnings, the car business alone cannot support the valuation. That's not a controversial statement anymore. It's the starting point for every serious Tesla discussion. So if the car multiple doesn't work, what is the market actually buying at this price? The answer is a portfolio of optionalities, and the market is pricing all of them simultaneously, as though each one will fully materialize. The first is full self-driving and robo-taxi deployment. Tesla has announced the Cybercab at a $30,000 price point, targeted for 2026. If autonomous ride-hailing scales, the revenue model shifts from hardware sales to recurring service economics. That changes everything about the valuation framework. But if is doing enormous work in that sentence. The second is Optimus, Tesla's humanoid robot program. Elon Musk has projected that by 2040, there could be 10 billion humanoid robots globally, priced between $20,000 and $25,000. The potential scale is genuinely staggering. But Tesla is not the only company building in this space, and the timeline to meaningful revenue remains speculative. The third is the AI infrastructure angle. Tesla operates one of the largest privately held supercomputing clusters in the world, built specifically to train its autonomous driving models. That compute infrastructure has real value independent of the car business. Whether it translates into monetizable AI services beyond Tesla's own use case is still an open question. What the market appears to be doing is applying a probability-weighted blend across all three scenarios simultaneously. The problem is that each scenario individually might justify a premium. Pricing all three as though they're all happening introduces compounding risk.
Here is what gets underweighted in the Tesla debate. The IRGC threat disclosure changes the Gigafactory expansion calculus in the Gulf, and that matters specifically because of Cybercab. Tesla had been in advanced discussions with Saudi Arabia and the United Arab Emirates about establishing manufacturing presence in the region. Both governments have been aggressive in offering incentives as part of their economic diversification strategies away from oil. That capital expenditure pipeline is now effectively frozen. The Middle East contributes a fraction of a percent to Tesla's current deliveries, so the direct revenue impact is negligible. But the indirect impact runs through the autonomous vehicle rollout narrative. A $30,000 Cybercab targeting 2026 needs manufacturing scale that doesn't currently exist. Every Gigafactory delay, whether from geopolitical risk, permitting complexity, or capital allocation constraints, pushes that timeline. And robotaxi economics only work at scale. A delayed Cybercab launch doesn't just miss a quarter, it defers the entire narrative catalyst that justifies the AI premium in the valuation. SpaceX filing its IPO paper simultaneously is not coincidental context. It draws capital attention, management bandwidth, and the Musk brand premium toward a separate vehicle. Tesla bulls have historically priced in a Musk attention discount. That discount may be widening. The bear path is coherent and does not require anything unusual to happen. It requires only that the EV business continues losing share, that the Cybercab timeline slips into 2027 or beyond, and that the AI robot optionality remains pre-revenue through the next earnings cycle. Under those conditions, the valuation compression is mechanical. A 200x earnings multiple on a declining margin car business with deferred AI catalysts is not stable. The recovery path requires one catalyst to land with enough force to reset the narrative. Not all of them, just one. A successful Cybercab commercial deployment in a single major metro, even at limited scale, would change the earnings model discussion overnight. Demonstrated Optimus production capacity, not a keynote demo, but a verified production number, would validate the robotics multiple independently of the car business. Or a licensing deal that monetizes Tesla's AI and autonomy stack for third parties would surface embedded value that the current income statement doesn't capture. Evidence leans toward continued pressure in the near term. The car fundamentals are moving in the wrong direction, and the AI catalysts are real but not yet on the income statement. That combination is uncomfortable at current multiples. The stock has already declined 19% year to date, which has compressed the multiple somewhat, but not enough to make the car business tube on its own. The question is not whether Tesla's AI bets are directionally correct. They probably are. The question is whether the current price already contains the full value of bets that are still years from revenue. At 200 times earnings, the market has already voted yes. The evidence for that confidence is still being assembled.